dividends are like the beating heart of the enterprise that we are investing in. They are steady, they are sturdy, and they keep on going. But how can we use dividends then to help us to find the very best investment opportunities today? What can we look for in terms of a historical record and past performance? And what does it mean about the potential for future performance? Today, we're going to begin to look at dividend safety. We're going to jump into some of the metrics and some of the measures that you might want to think about when you begin to invest in dividends. Now, stick with me to the end because I'll be discussing some of the very important metrics and factors that you might want to consider if you don't want to make a big mistake when investing for dividends. Stick with me today. So what exactly do I want to look at when I think about dividend safety? So today, first of all, we are going to briefly explain what dividend safety is, what it means, and why it's important. Number two, we're going to think about metrics and measures and a figure, a way of calculating a dividend safety score. Now, even if you're not subscribed to a service that lets you do this, we're going to look at a checklist approach that helps you to evaluate this dividend safety on your own. We're also going to talk a little bit about the business fundamentals because it's the business fundamentals that generate the revenue, that generate the profit and the cash flow that is going to be paid out in dividends. And so the business fundamentals are really important to understand. We are also going to look at the dividend payout ratio, this idea of how much perhaps is too much. We're also going to, when we think about this, consider the different types of industries and the different types of companies and what this might mean for the dividend payout ratio. Finally, we're going to look at history. We're going to begin to understand a little bit about what has happened in the past to companies and what this might mean for them moving forward in terms of the dividends that they pay out. Okay, let's get into it. What exactly is this idea of dividend safety? Now look, whether or not you are a seasoned investor, you've been doing this for years, or you're just getting started and you want to have some dividends, a key point to remember is you need to evaluate whether or not these dividends are safe. Dividends are not a guaranteed source of income, and there's many reasons why they might disappear in the future. And so really understanding dividend safety is fundamental to investing in companies that pay dividends today. So really at the heart of it, the dividend is not a guaranteed payment. Now, at the heart of it, dividend safety is all about the certainty that this dividend is going to continue to be paid now and into the future. When we're investing for dividends, we're usually looking not just for capital returns, but also for this consistent source of income flowing in to our brokerage accounts time and time again. So in this case, think about safety, really. So in this case, think about dividend safety as being indicated. A simple way of thinking about this is dividend safety is essentially a health and safety indicator for your dividend payout. Now, why is this going to be important for you? Well, the simple answer is it's going to give you safety and security and a sense of well-being, knowing that your company that you have invested in is more likely than not to be able to continue to pay out that dividend into the future. Now, when you begin to think of it, let's use an analogy. Dividend investing is very much like taking a very long car journey. Dividend investing is usually part of a lengthy year or decade-long process designed to help you create wealth and income for you and your family into the future. In a similar way, a long car journey is going to take a long period of time. Now, consequence of that, when we're going on a long car journey, we often do some safety checks on the vehicle. We want to make sure it's roadworthy. We want to make sure it's going to get us to where we want to go. And so we do tire pressure checks. We make sure that the fuel doesn't need to be changed. There's still brake fluid. There's so many things that can go wrong during a long car journey. And dividend investing and dividend safety is very much the same thing. Because we're investing for a long period of time, we want to make sure that there's not going to be any bumps in the road that are going to throw off our investments and throw off the dividend flows into our brokerage account. So when we're thinking about dividend safety, it helps us to assess the healthiness of the companies that we're investing in and the health of the companies that we are investing in so that we know that they're going to help us over decades to get us to where we want to go. Now, with the car, there's lots of well understood guidelines when it comes to dividend investing and dividend safety. This is where things get really interesting. There's a whole host of different measures that are going to be important for us. And because of the length of time that we're investing for, it's not static either. It's not something that we can set and forget and then ignore. It's going to be constantly changing, this idea of dividend safety, constantly changing what's going on in the macroeconomic environment. In the macroeconomic environment, there's going to be a range of different factors that influence the dividend safety. In the macroeconomic environment, there will be a range of factors that influence the dividend safety. As a very simple example, changes to the payout ratio, changes to income, changes to cash flow or investment requirements for a company to continue to remain competitive, changes perhaps to their overall level of competitive advantage, which might impact on their margins. There's a huge number of things here that can change over time. Now, does this mean that dividend safety is some sort of pipe dream that we can't deal with because it's simply too complex? The answer is no. We can begin to assess the dividend safety for our companies that we invest in. So how can you really begin to tell if the dividend's going to be safe? I don't have a crystal ball, but there's certain things that we can begin to assess to understand whether or not the company's being well managed and whether or not it will be able to pay a dividend next year, 5 years from now, or a decade from now. For example, we can look for a history of consistent and steady earnings growth. We can look for a history of cash flow positive, that cash flow is going to cover that dividend. And so there's a number of things that we can look at. Other important factors, particularly in the last couple of years post-COVID pandemic, is, for example, the amount of debt that a company holds. As the interest rates begin to rise, the cost of that debt can be a huge burden for companies saddled with too much debt. Now, understanding dividend safety, it's a little bit like being a detective. It's a little bit like being a super sleuth. We're going to be looking at quite a number of different metrics and different pieces of information, different clues. We're going to be putting these all together to try and estimate and try and predict whether or not, based on all the information that we do have, based on some assumptions that we will have to make, whether or not there's a high level of dividend safety or whether or not this is an opportunity where the dividend may disappear in the future. Okay, now that we've got a better understanding of what dividend safety is and why it's important, let's get into some of the nitty-gritty. Let's begin to think about what we can do to calculate and assess this using some very objective performance measures where we don't need to have too much evaluation and personal judgment. Let's get into it. Have you ever been really surprised or shocked by a sudden and unexpected dividend cut from a company that had a really strong and steady history of dividend payments? If so, let me know about your thoughts and your experiences down below in the comments section. So as we begin to think about this, it's often a decision of weighing up current yield against dividend safety. So let me know in the comments below, how do you make that balance? What is important to you and your family in finding that balance between yield and safety? Let me know down below. Let's discuss that a bit more. Look, there's a range of different ways of making overall dividend safety and generating an overall composite or combined dividend safety score. I know that there's subscription websites out there on the internet, but you know what? We can do a pretty good job ourselves. So here's 10 simple things that we can look at and we can measure. We can get much of the data from publicly available sources or from very affordable subscription sources that are a bit more general. So let's get into it. What are we looking for? So we often look at a payout ratio. So when we're looking at a payout ratio, we're looking at the earnings for the company and the amount that they're paying out in dividends. In a very simple sense, if a company brings in a certain amount of money in earnings and they're paying out a very large proportion of that in dividends, it's less likely to be secure in the future. There's not a lot of buffer. There's not a lot of margin of safety for this company. If something goes wrong with the earnings and they begin to drop down, it may put that dividend at risk. On the other hand, if they had very low dividends compared to their earnings level, they're more likely to be able to maintain that and withstand fluctuations in their earnings with time. Now, many investors will also, beyond looking at simply earnings, look at the cash flow or the free cash flow ratio and the dividend payout ratio to the free cash flow. Why? Earnings can be manipulated and it includes a lot of non-cash items. Free cash flow, on the other hand, is actual money, tangible money coming into the company that is available for the managers to use. So that level is always high compared to the dividends that need to be paid out. There's a lot of assurance there that the cash flow will be there in the future to continue to pay out those dividends. Now, the free cash flow payout ratio is not going to be as valid in every single sector. For example, in utilities, there's a very high level of investment required, and instead of free cash flow, just simply looking at the dividend payout ratio is usually going to be sufficient. Number 3, debt to equity ratios. Now, this is also really important. As we've touched on, high level of debt to value of the company means that they're going to be more at risk in changing circumstances. If interest rates suddenly spike, or if they're getting close to a debt maturity where they've got a big chunk of debt that they'll need to pay back, this could put pressure on their ability to divert cash flow to pay their dividends into the future. So the debt to equity ratio simply measures the level of debt outstanding compared to the overall value of the company. 4, the interest coverage ratio. Now, this is simply a case of looking at how many times over the company can actually pay the interest on the amount of debt that they have. Now, this is related to the level of debt holdings and also the cost of that debt and the impact it has on this company's ability to pay out dividends. If, for example, they don't have a lot of cash left over to pay off both the interest on the debt and then have money for the dividends, they're less likely to be able to pay out dividends in the future. So companies with a lower level of coverage, possibly a little bit more risky for the dividends. Now, of course, simply dividend yield is also an important factor. Companies with a high dividend yield usually indicate that there's something potentially challenging and wrong here. Now, there's 2 reasons for this. Number 1, the company may have opted to pay a very high dividend yield. Now, this means that they're less likely to be able to maintain that into the future. Alternatively, it might not be the dividend level itself that the company's changed. It could be that the price of the company has fallen quite dramatically, which at the same level of dividend payout is going to accelerate or push up the dividend yield that we see when we look up this metric. Now, if the prices have come down and crumbled for a company, that usually means that the market is worried about some significant and substantial risk, and that is something that a dividend investor will need to worry about.
The dividend growth rate is also important. There are many companies that pay a smaller dividend yield now, but they grow this at a very fast and accelerated rate, meaning that an investment in the company now will probably continue to grow and pay growing dividends for many years to come.
Earnings per share, or the EPS, and EPS growth over time. A nice consistent EPS growth indicates that a company is going to continue to grow and will continue to be able to not only pay out the current dividend that they're paying, but also hopefully begin to increase that dividend moving forward. The retention ratio is also important. Now, this is essentially the amount of cash that the company retains into itself that it can then use to grow and expand their business. So it's not about the dividends today or next year, but it's about the ability to bring money into the company and continue to invest and continue to grow that company into the future, looking forward several years to look at the dividend safety into the future. The dividend coverage ratio is also important. Now, this is essentially the amount that a company, or the number of times a company can pay that dividend given the level of earnings that they do have. So obviously companies with earnings that far exceed the level of dividends that they have to pay out are going to have a more stable and more reliable stream of dividend payments into the future. Number 10, this one's a little bit more ambiguous and there's some level of judgment here, but the overall stability of earnings growth and revenue growth. So this is important. We're talking about just general, nice, steady, stable growth into the future. We're not looking for companies with sudden big spikes, which then disappear. We're looking for companies that can grow steadily and stably over time. That's my personal, and there are some metrics that we could use for this, but again, this is one where there's a bit more ambiguity and a bit more judgment that you need to apply. So what's this idea about the business fundamentals? Why are business fundamentals so important to dividend safety? So let's get into it. There's a couple of really important things that we need to think about. Number 1 is this idea of revenue or sales. So what is the amount of money that the company actually brings in? Now, by itself, that's a somewhat ambiguous term because even once they bring in money, there's a whole load of expenses and payments that also have to be made before we think about what comes out to us as investors as dividends. But if we're looking for those companies with growing revenues, it is also an indicator that they're able to grow into the future and perhaps that they've got a strong competitive advantage and moat available for them. Number 2, earnings. So this is the famous bottom line. So this is the money left over, but a lot of those expenses are deducted. So this is almost like the profitability. Now, of course, there's different ways of measuring and evaluating earnings, but there are some standard forms that will be reported. Now, in general, what we're looking for, and what I like to look for, is a nice and steady earnings growth. I'm not looking for companies with erratic earnings that follow business cycles. I'm looking for companies where they can grow those earnings with time, assuring me that this company is going to continue to grow into the future and pay me dividends. I don't want companies with sudden big spikes and then a decrease the next year. There's also the importance of cash flow. Though earnings can be somewhat manipulated, there's a whole load of different accounting ideas there where managers and boards can help just adjust and massage those earnings figures, but cash is king. Cash cannot be hidden. Cash cannot be manipulated away. And so when I'm looking at a company with this idea of growing cash flow with time, this is a more immutable, unchangeable metric, which is something that is more stable and certain. Now, the balance sheet is also really important, and companies with good, strong, stable cash flows, indicating stability in business, can often then build up and develop a very strong balance sheet, perhaps a strong fortress balance sheet. So I'm looking for companies perhaps with a lot of cash, with a lot of assets, both long-term assets as well as short-term assets that could be liquidated if required in an emergency. I'm looking for companies with cash. I'm looking for companies that don't have huge amounts of debt. Companies without lots of debt coming up in the next couple of years that they might struggle to pay for. Now, another useful metric is one that I don't hear talked about very much, return on equity. Now, in essence, this is a measure of how effective the company and the managers are actually creating a return based on the equity invested by the investors. Now, high levels of return on equity that are consistent will usually be indicative of a company that has a very strong market position and one where they can continue to grow because of this powerful market position. Now, the final factor here is the general market dynamics. So how quickly is this market growing? Are there any external threats to the market? And based on these elements, what is the likelihood for this company to have long-term success into the future? Does this company within this market, does this company as an investment, does it have a competitive advantage where they're going to be able to fend off competitors and continue to earn larger margins and good cash flow to pay out dividends? That's what I'm looking for. Now, even as I talk about this is not just about the numbers. This is also about being able to assess the story that the numbers are telling, to assess what's going on behind the numbers reported on, say, Yahoo Finance. There's a level of interpretation here and a level of additional sleuthing that you need to go through, where you need to put together the puzzle of these numbers and try and understand what it means about the business fundamentals. Okay, let's talk about the dividend payout ratio. Now, it's really important to remember that this is going to be different for different types of businesses and also different sectors. So there's no one size fits all, but there's a couple of important things that we can remember about the dividend payout ratio. Companies that are paying out a large proportion of their earnings cash flow as a dividend, they've got less wriggle room. Now, it means that there's going to be less money there to invest in future growth, so we'll probably be expecting a slower dividend growth rate with time, but it also means that something happens to the earnings of the cash flow. If there's a bad year or there's a market downturn, it could put pressure on their ability to continue to pay out those juicy dividends, and that can be important. On the other hand, a very low payout ratio means that there's large levels of earnings compared to the dividends that are being paid out. Now, in terms of retention, it means that the company's keeping a lot of those earnings or the cash flow, enabling them to support, hopefully, much stronger growth going into the future, which should enable them to pay continually growing dividends into the future. Yes, this is going to be industry specific. So, for example, in the utilities sector, there tends to be a higher level of payouts, and this makes some sense due to the earnings of all types of companies, the historical dividend payouts. Why care about what happened to dividends 10 or 20 or more years ago? Well, the answer is very simple. Companies have a culture, and their future is determined by what has happened in the past. So past performance can help us to assess several things. It can help us to assess the likelihood that the company is going to grow or change those dividends in the future. It can also give us some perspective into the management and what their commitment is to the dividend, as well as their principles around capital allocation. Now, capital allocation is simply how these companies are going to invest that capital, whether or not it's paid out in dividends or growing the company to help the shareholders long term. Now, there'll be comments about this on earnings calls, for example, or perhaps even in shareholder presentations. And so we can begin to piece together what that philosophy is. A long, consistent history of dividend payouts that are continually growing will usually give us reassurance that the company is going to do what they can to continue to grow these into the future and protect those dividends. Now, of course, there's always going to be unusual situations that happen. Some companies can pay dividends consistently and grow them for 25, maybe even 50 or more years. Every now and then, the company will stumble. VF Corporation, for example, in 2023, cut their dividend quite heavily, and that was a bit of a shock to the market. WPC, also cut their dividend in 2023 as they announced that they were spinning off the offices from their wider portfolio, reducing the amount of income that the company has and therefore right-sizing or adjusting the income or the dividend level downwards to ensure that they would continually have a little bit more buffer moving forward. Now, from those examples, we can take heed of the warning that the past does not predict and guarantee a future outcome. Regulatory changes, market changes, these can all have an impact on a company's long-term ability to sustain a strong dividend payment. We're getting to the end of the video, and hopefully at this point you're beginning to realize that dividend safety and dividend payments are not just numbers on a page. There's a story, there's a narrative behind the dividends and behind each company that we invest in, within each business. A story that we must understand, that we have to know, and a story that we also have to be able to trust to take us forward as investors into the future with this company. I would personally encourage you to take a really good look at the companies you're invested in. What is the story? What is the narrative? Is this one that you have confidence in? Is it one that you can get behind long term? Now, please, if you know of some companies with a really great track record where you think there's some strong dividend growth opportunities or stability of payments into the future and good yields, let me know in the comments down below. Let's discuss it and find some great opportunities together. Now, look, if this has been helpful for you, if it's helped you to learn a little bit more about investing, about the market, please do hit that like button and hit that subscribe button. Help me to get in touch with you. Your support is going to help us to grow the channel and help us to develop more useful videos and give more useful content to you and many other people. Thank you for watching. Let's keep this conversation going. Hit me up in the comments down below with your thoughts about dividend safety today.